Hello and welcome to the first ever live stream of the Berkshire Hathaway annual shareholders meeting on Yahoo Finance. We are live at the CenturyLink Center in Omaha, Nebraska, where some 40,000 people waited in the pouring rain this morning to hear Chairman and CEO Warren Buffett, the world's most famous investor, be peppered with questions for the next 7 hours for all of the world to see. I'm Alexis Christoforous of Yahoo Finance, coming to you from the exhibition hall where all the Berkshire brands come to sell their wares this weekend, including the Clayton home behind me that is selling for $78,900. It's a modular home, and it is actually at a discount for Berkshire shareholders. They get it for $10,000 less than they would if they weren't shareholders. All right, in just a moment, you're going to hear from the Oracle of Omaha himself. But you know what? We've got our own Oracle here at Yahoo Finance. It is Editor-in-Chief Andy Serwer joining in front of the Fruit of the Loom store. And Andy, I know it's already been a very busy morning here. There have been newspaper tosses and cheerleaders. What are we going to see? It's the magnitude of the man, isn't it?
That's right, Alexis. And people have been streaming into this Fruit of the Loom exhibit all morning looking to buy stuff, and as well all across this giant exhibition hall to other Berkshire companies like See's Candy, Geico, Dairy Queen, and they're buying all of this Berkshire bric-a-brac, basically. You can see these T-shirts, underwear, Heinz ketchup, Kraft mac and cheese. There's some See's Candy, some T-shirts, even this Buffett fan. And, you know, basically, all these people are here just to hear what Warren Buffett has to say. He is the Oracle of Omaha, and as you suggested, the world's greatest investor. But even more than that, he is an incredible businessman who's built Berkshire Hathaway up into one of the most important and biggest companies in the world, employs over 350,000 Americans, does tens of billions of dollars of sales every year, has all these companies. But even more than that, Buffett has become an American icon who influences sports, the arts, movies, politics, and government as well. Presidents, senators, CEOs from around the world want to hear him speak, and that's why everyone's here today, Alexis.
Yeah, they want a little bit of that Midas touch, right, Andy? He certainly has become part of pop culture. All right, now let's hear from the man himself. Andy, I know you sat down with Warren Buffett recently, and he gave you a preview of what we're going to see today, right?
That's right, Alexis. I've had the opportunity to speak with Buffett a number of times over the years. I sat down with him recently to talk about this weekend and how it's become this incredible extravaganza. Take a listen.
People love to hear what you and Charlie have to say, but you throw the newspapers and, you know, you have all these kind of little mini events that surround it. So you've contributed building it up, right?
Yeah, there's a little bit of P.T. Barnum in me.
But did you ever plan on it getting to be what it is today?
No, I never dreamt it would get this large. I mean, we have had to move the venue about 6 times. Fortunately, they built a new convention center here 6 or 7 years ago, or we would have had to, I don't know what we would have done. It surprised me. We had well over 40,000 last year. And if you go back 25 years, Berkshire didn't even have 40,000 shareholders. So it just keeps going.
And you're kind of maxed out, which is one reason why you decided to live stream. Can you talk about why you've decided to live stream this at Yahoo Finance?
Yeah, well, there's a couple reasons, but one reason certainly is that we've sort of maxed out in Omaha. We couldn't take much in the way of further gains at the meeting. The room at the convention center, the main room, holds about 18,000. There's 5 overflow rooms. And then last year we filled all those, and we had to go across the street to the Hilton Hotel. And so we had a couple more big rooms over there that were pretty full. So, you know, in effect, we were starting to stream it a little bit to our own audience. So that was one reason. But beyond that, you know, we get people from all over the world. We have maybe 100, 200 from Australia, hundreds from China. They come from all over. And not everybody can afford that, or it's not an easy expense to afford. So this gives people a chance that, you know, don't want to spend a lot of money on airplanes, and it's just difficult to get to from I think we had 55 countries that people came from last year. So we'll see. We'll make it a little easier for them.
So it's a big event. You go up on stage with Charlie Munger, your partner. Do you get nervous? What's it like going up there?
No. Charlie grew up in Omaha, but he only comes here now for the annual meeting once a year. And frequently, we don't see each other till just right before the meeting starts, because he's off doing something and I'm off doing something. And when I know the movie's coming to an end, I'm sit out with the audience watching the movie, which starts at 8:30 Central Time and runs till 9:30. And about 9:25, they start rolling the credits on the movie, and Charlie gets up. He sees me get up, and we walk backstage. And then when the movie finally is over, we walk out on the stage. But we don't talk about, we don't consult on anything. I have no idea what he's going to say. And I walk out there, and Charlie's 92, I'm 85. He lost an eye some time ago, so I just tell the audience, I can see and he can hear. We got to work together. I mean, we have no choice. Maybe I can't remember his name anymore, but that's a minor detail.
Do you have a theme to the meetings, or is there some sort of program at all?
No, we go wherever the questions lead us. I mean, we have 3 journalists, we have 3 Wall Street specialists, and then we have the crowd. So we keep alternating among them. And last year we had over 60 questions. And we get no advance notice of it. We do not know from the crowd who's going to be asking questions. They draw at various stations where we have a microphone, and anything goes. And if you've been to the meeting, I would say that practically none of the questions come from anybody in Omaha, and a good number come from people outside the United States.
I mean, you learn something every time you talk to the man, Alexis, and what was most striking to me from that conversation was his flexibility. I mean, here's an 85-year-old guy who famously doesn't really know much about technology, who's decided to stream his meeting.
Exactly. I mean, he is one of the oldest CEOs in the world, and this was his idea. He's embracing the technology, and we applaud him for that.
I mean, he continues to learn every day. The man is like a sponge. He reads constantly. He's constantly talking to people. He's very, very curious. And I think that's part of what's made him so successful.
For sure. Sharp as a tack. Thanks for bringing us that interview, Andy.
All right, Alexis.
Come on over here, Bob. Get to my left. We want to chat about today's event. You're our Buffettologist, as we said. Thanks so much for being here. What year is this for you now at the meeting?
This is my 20th year. I first came out when the meeting was held at a former racetrack called our Xarban racetrack, which is Nebraska spelled backwards.
Okay, I wouldn't have known that. Thank you. So you've really seen this thing grow. Talk to me about the mysticism of Warren Buffett and why this faithful crowd follows him and hangs on his every word.
Well, I think he's just a regular guy who speaks the truth. Unlike Wall Street, Warren at the meeting when I first attended 20 years ago would say, Wall Street will sell you anything that you're willing to buy, and that Wall Street is the legal pickpocket for the average investor. He educates us, he entertains us, and he gives us the hard truths about finance, the economy, and life.
Well, tell me, he's sort of like everybody's grandpa or uncle in many ways, right? Talk to me about what we might expect him to say during the meeting. We know that he is holding on to shares of IBM at a loss right now. IBM stock is down more than 14%. It's usually policy to not talk about individual stocks at this meeting, but do you think he might, and do you think maybe IBM was a mistake?
Well, he says it may have been a mistake. He's said that recently. He may talk about it, but he's likely to not talk about anything they've purchased or they are holding or that they've sold. But IBM may be an exception. I think he's likely to talk to you about Precision Cast Parts, which is their largest acquisition. And in fact, it's an acquisition that was brought to him by the likely successor to Warren Buffett on the investment side, Todd Combs.
And that's my other question. Do you think he's going to address his succession plan here today? I mean, he is 85. We all know he's going to live to 200. But is he going to talk about that succession plan today?
No, he's not likely to talk about that, except possibly joke that he plans to work till 5 years after his retirement and then communicate with regular seances with the board of directors.
I do not doubt it. Bob Miles, thanks so much for stopping by. And here's Warren Buffett.
Good morning. I'm Warren Buffett. This is Charlie Munger. I'm the young one. You may notice in the movie, incidentally, that Charlie is always the one that gets the girl.
And he has one explanation for that, but I think mine is more accurate. That, as you know, every mother in this country tells her daughter at an early age, if you're choosing between two very old and very rich guys, pick the one that's older. I'd especially, we're webcasting this for the first time, so I'd especially like to welcome our visitors from all over the world. We're having this meeting simultaneously translated into Mandarin, and that poses certain problems for me and Charlie, because I'm not sure how sensible all our comments will come out once translated into Mandarin. In fact, I'm not so sure how sensible they come out initially sometimes, but we're delighted to have people around the world joining. Now we'll move on to the questions. I just asked with the audience that you limit your question to one question. The multiple questions have a way of sneaking in occasionally, but so let's keep them to a single question. We'll start off with the journalist group on my right, and we'll start off with Carol Loomis.
Good morning. I'll make my very short a little speech about the fact that the journalists and the analysts too have given Charlie and Warren no hint of what they're going to ask. So they will be learning for the first time what that's going to be also. This question comes from Eli Moises. In your 1987 letter to shareholders, you commented on the kind of companies Berkshire liked to buy, those that required only small amounts of capital. You said, quote, because so little capital is required to run these businesses, they can grow while concurrently making almost all of their earnings available for deployment in new opportunities. Today, the company has changed its strategy. It now invests in companies that need tons of capital expenditures, are overregulated, and earn lower returns on equity capital. Why did this happen?
Yeah, well, it's one of the problems of prosperity. The ideal business is one that takes no capital, but yet grows. And there are a few businesses like that, and we own some, but we are not able. We'd love to find one that we could buy for 10 or 20 or 30 billion dollars that was not capital intensive, and we may, but it's harder, and that does hurt us in terms of compounding earnings growth, because obviously if you have a business that grows and gives you a lot of money every year and doesn't take it, it isn't required in its growth, you get a double-barreled effect from the earnings growth that occurs internally without the use of capital, and then you get the capital it produces to go and buy other businesses. And See's Candy was a good example of that. I've used that. Back when the newspaper business was good, our Buffalo newspaper, for example, was a good example of that. The Buffalo newspaper was making, at one time, $40 million a year and had no capital requirements. So we could take that whole $40 million and go buy something else with it. But increasing capital acts as an anchor on returns in many ways, and one of the ways is that it drives us into, just in terms of availability, it drives us into businesses that are much more capital intensive. You just saw a slide, for example, on Berkshire Hathaway Energy, where we just announced, just in the last couple of weeks, we announced a $3.6 billion investment coming up in wind generation. And we've pledged overall to have $30 billion in renewables. Anything that Berkshire Hathaway Energy does, anything that BNSF does, takes lots of money. We get decent returns on capital, but we don't get the extraordinary returns on capital that we've been able to get in some of the businesses we require that are not capital intensive. As I mentioned in the annual report, we have a few businesses that actually earn 100% a year on true invested capital. And clearly that's a different sort of operation than something like Berkshire Hathaway Energy, which may earn 11 or 12% on capital, and that's a very decent return, but it's a different sort of animal than the business that very low capital intensity. Charlie?
Well, when our circumstances changed, we changed our minds.
Slowly and reluctantly.
In the early days, quite a few times we bought a business that was soon producing 100% per annum on what we paid for it and didn't require much reinvestment. If we'd been able to continue doing that, we would have loved to do it. But when we couldn't, we went to Plan B. And Plan B is working pretty well, and in many ways I've gotten so I sort of prefer it. How about you, Warren?
Yeah, that's true. When something's forced on you, you might as well prefer it. We knew that was going to happen, and the question is, does it lead you from what is a sensational result to a satisfactory result? And we're quite happy with a satisfactory result. The alternative would be to go back to working with very tiny sums of money, and that really hasn't gotten a lot of serious discussion between Charlie and me. Okay, from the analyst group, Jonathan Brandt.
Hi, Warren. Thanks for having me again.
Thanks for coming.
My first question is about Precision Castparts. Besides your confidence in its talented CEO, Mark Donegan, what in particular do you like about their business that gave you the confidence to pay a historically high multiple? Are there ways Precision can be even more successful as essentially a private company? For instance, are there long-term investments to support client programs or acquisitions that Precision can make now that they couldn't realistically have done as a publicly traded entity?
Yeah, we completed the acquisition of Precision Castparts at the end of January this year. We made the deal last August, and you covered the most important asset in your question. Mark Donegan, who runs Precision Castparts, is an extraordinary manager. I mean, Charlie and I have seen a lot of managers over the years, and I would almost rank Mark as one of a kind. I mean, he is doing extremely important work in terms of primarily making aircraft parts. I would say that there's certainly no disadvantages to him to be working as and for that company to be a subsidiary of Berkshire and not be a public company. And I think he would say, and I think Charlie and I would agree with him, that over time there could be some significant advantages. For one thing, he can spend 100% of his time now on figuring out better things to do with aircraft engines. And it was always his first love to be thinking about that, and he did spend most of his time, but he also had to spend some time, explaining quarterly earnings to analysts and perhaps negotiating bank lines and that sort of thing. So his time, like all of our managers, can be spent exactly on what makes the most sense to them in their business. Mark does not have to come ever to Omaha to put on some show for me in terms of justifying $1 billion acquisition or planned investment. He doesn't have to waste his time on anything that isn't productive. And running a public company, you do waste your time on quite a bit of stuff that isn't productive. So I would say we've taken the main asset of Precision Cast and made him, in this case, even more valuable to the company. In terms of acquisitions, Precision's always made a number of them, but as being part of Berkshire, there's really no limitations on what can be done. So there again, his canvas has been broadened, enlarged with the acquisition by Berkshire. I see no downside whatsoever if he needs capital, I've got an 800 number, and he wasn't paying much of a dividend before, but he doesn't have to pay any dividend now. And Precision Cash will do better under Berkshire than it would have independently, although it would have done very, very well independently. Charlie?
Yeah, well, in the early days, we used to make wise-ass remarks. And Warren would say, we buy a business that an idiot could manage, because sooner or later an idiot will. And we did buy some businesses like that in the early days, and they were widely available. Of course we'd prefer to do that, but the world has gotten harder, and we had to learn new and more powerful ways of operating. A business like Precision Castparts requires a very superior management that's going to stay superior for a long time. And we gradually have done more and more and more of that, and it's simply amazing how well it works. I think to some extent we've gotten almost as good at picking the superior managers as we were in the old days of picking the no-brainer businesses.
Yeah, we would love to find, we won't be able to find them because they're very rare birds, but we would love to find another 3 or 4 of a similar type to Precision Castparts, where they forever are going to be producing something where quality is enormously important, where the customers depend very heavily on them, when there's contracts that extend over many years, and where people don't simply just take the low bid in order to get this gadget of one sort or another. It's very important that you have somebody there that has enormous skill running the business, and their reputation among aircraft manufacturers, engine manufacturers, is absolutely unparalleled. Okay, now we go to the audience, and we'll go up to section 1. And if you'll give your name and where you're from, I'd appreciate it.
Hi, good morning. My name is Gaspar. I'm Spanish, and I come from London. I admire you both in many ways, but I would like to know that when looking backwards, what would you have done differently in life in your search for happiness?
Well, I'm 85, and I can't imagine anybody any happier than I am. So, by accident or whatever, I'm sitting here eating exactly what I like to eat, doing in life exactly what I love to do with people I love. So it really doesn't get any better than that. And I did decide fairly early in life that my favorite employer was myself, and I think that presented. I've managed to avoid really aggravation of almost any sort. Really, if you or those around you that you love have health problems or something, I mean, that is a real tragedy, and there's not much you can do about it except it. But Charlie and I have really been blessed. I mean, here Charlie is 92, 85, and he's doing every day something that he finds fascinating. I think he probably finds what he is doing at 92 as interesting, as fascinating, as rewarding, as socially productive, as any period you could pick in his life. And so we've been extraordinarily lucky. We've been, we're lucky it's a partnership. It's more fun doing things as a partnership. So I've got no complaints. It'd be very churlish of me to have any kind of complaint. And I would say, if you're talking about business life, I don't think I would have started with a textile company. Charlie?
Well, looking back, I don't regret that I didn't make more money or become better known or any of those things. I do regret that I didn't wise up as fast as I could have. But there's a blessing in that too, Now that I'm 92, I still have a lot of ignorance left to work on.
Now we'll talk to an insurance man about it. Cliff Gallen.
Thank you. In terms of growth and profitability, GEICO really got whooped by Progressive Direct over the last year. In 2015, Progressive Direct's auto business grew policy count by 9.1%, GEICO only 5.4%. And in terms of profitability, the combined ratio at Progressive was a 95.1 and GEICO's was a 98.0. Is this evidence that Progressive's investments in technology like Snapshot, investments that GEICO has spurned, is it making a difference in a time of difficult loss trends? Why is GEICO suddenly losing to Progressive Direct?
Yeah, well, I would say this, over the last, well, I forget what year it was we passed Progressive and what year it was we passed Allstate, but GEICO's growth rate in the first quarter was not as high as in the past couple of first quarters, but it was quite satisfactory. Now, the first quarter is by far the best quarter for growth. But last year, both frequency, how often people had accidents, and severity, which is the cost per accident, in other words, just how much those accidents cost you, both of those went up quite suddenly and substantially. And Progressive's figure showed that they were hit by that less than Allstate and GEICO and some others. But I don't think you'll see necessarily those same trends this year. It's an interesting thing. Last year, for the first time in I don't know how many years, the number of deaths in auto accidents per 100 million miles went up. Now, if you go back to the mid-1930s, there were almost 15 people killed per 100 million miles driven. It got down to just slightly over 1, from 15 to 1. You had roughly as many people killed in auto accidents in the mid-1930s, about 33,000 a year, as we had last year, or the year before, when people drove almost 15 times as many miles. Cars have gotten far, 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 far safer. And it's a good thing, because if we'd had the same rate of deaths from auto accidents as we had in the 30s, relative to miles driven, we would have had over 500,000 people die last year from auto accidents instead of a figure closer to 40,000. But last year, for the first time, there was more driving, and I think there was more distracted driving. So you really had this uptick in frequency and more important, in severity. GEICO has adjusted its rates. As I mentioned, my own prediction would be that the underwriting margins at GEICO will be better this year than last year, although you never know when catastrophes are coming along. March and April have had a lot of cat activity. I made a bet a long time ago on a mental one on the GEICO model versus the Progressive model, and as I say, they were significantly ahead of us in volume a few years back, and we passed them, and we passed Allstate, and as I put in the annual report, I hope on my 100th birthday that the GEICO people announced to me that they passed State Farm, but I have to do my share on that too by getting to 100, so we'll see what happens on that particular one. Charlie?
Well, I don't think it's a tragedy that some competitor got a little better ratio from one period. GEICO's quadrupled its market share since we bought all of it.
Quintupled, yeah.
Quintupled, all right. I don't think we should worry about the fact that somebody else had a good quarter.
Yeah. I think it's far more sure that Geico will pass State Farm someday than that I'll make it to 100, I'll put it that way. Okay, we'll go to the shareholder from Station 2.
Greetings to all of you from the Midwest of Europe. I'm Norman Rentrop from Bonn, Germany, a shareholder since 1992. My question is about the future of salesmanship in our companies. Warren, you have always demonstrated a heart for direct selling. When we met you in the midst of a tornado warning in the barber shop, you immediately offered to write insurance for us.
That's true.
Now,
they were all huddled down there in the barber shop, and there wasn't going to be any tornado, so I told them if they give me $1, they can go upstairs, and if anything happened to them, I'd pay them, I forget, $1 million or something of the sort.
Now, we see with the rise of Amazon.com and others a shift from push marketing to pull marketing, from millions of catalogs having been sent out in the past to now consumers searching on what they are looking for. What is your take on how this shift from push to pull marketing will affect our companies?
Well, Norman, the development you refer to is huge. I mean, really huge. And it isn't just Amazon, but Amazon is a huge part of it. And what they've accomplished in a fairly short period of time and continue to accomplish is remarkable. The number of satisfied customers they've developed. And we don't make any decision involving even the manufacturing of goods, the retailing, whatever it is, without thinking long and hard about what the world will look like in 5 or 10 or 20 years with that powerful trend, really hugely powerful trend that you just described. So we don't look at that as something where we're going to try and beat them at their own game. You know, they're better than we are at that. And so Charlie and I are not going to out Bezos by a long shot. But we are going to think about that. It does not worry us, obviously, with the precision cast. But it doesn't worry us in terms of the overwhelming majority of our businesses. But it is a huge economic trend that 20 years ago was not on anybody's radar screen, and lately has been on everybody's radar screen, and many of them have not, including us in a few areas, have not figured the way to either participate in it or to counter it. The Geico is a good example of a company that, in an industry that had to adjust to change, and some people made the change better than others. We were slow on the internet. The phone had worked so well for us, and this traditional advertising, and the phone had worked so well that there's always a resistance to think about new possibilities. When we saw what was happening on the internet, we jumped in with both feet, and with mobile and whatever. But there are the nature of capitalism is somebody's always trying to figure, if you've got a good business, they're always trying to figure out how to take it away from you and improve on it. And the effect, I would say, just of Amazon, but others that are playing the same game, the effect on industry, the full effect is far from having been seen. I mean, it is a big force and it already has disrupted plenty of people, and it will disrupt more. I think Berkshire is quite well situated. For one thing, one big advantage we have is we didn't ever see ourselves as starting out in one industry. I mean, we went into department stores, but we didn't think of ourselves as department store guys, or we didn't think of ourselves as steel guys or tire guys or anything of that sort. So we've thought of ourselves as having capital to allocate. If you start with a given industry focus and you spend your whole time working on a way to make a better tire or whatever it may be, I think it's hard to have the flexibility of mind that you have if you just think you have a hopefully large and growing pile of capital, and trying to figure out what is the best next move that you can make with that capital. And I think we do have a real advantage that way. But I think Amazon's got a real advantage too, in this intense focus on having, hundreds of millions of generally very happy customers getting very quick delivery of something that they want to get promptly, and they want to shop the way they shop. And if I owned a bunch of shopping malls or something like that, I would be thinking plenty hard about what they might look like 10 or 20 years from now. Charlie?
Well, I would say that we failed so thoroughly in retailing when we were young that we pretty well avoided the worst troubles when we were old. I think net Berkshire has been helped by the internet. The help at Geico has been enormous, and it's contributed greatly to the huge increase in market share. And our biggest retailers are so strong that they'll be among the last people to have troubles from Amazon.
This is Cora and Dan Chen from Talgar Investments of Los Angeles. This annual meeting reminds me of the magical world of Hogwarts, of Harry Potter. This arena is our Hogwarts. Warren, you are our headmaster and Professor Dumbledore.
I haven't read Harry Potter, but I'll take it as a compliment.
Charlie's our headmaster Snape, direct and full of integrity. The magic of long-term, concentrated value investing is real, yet similar to Harry Potter, the rest of the world doesn't believe we exist. Your letter to me has changed my life, and your Secret Millionaires Club has changed my children's life. They go to class chatting about investing. My question is for my children watching at home today and the children in the audience. How should they look at stocks when every day in the media they see companies that have never made a dime in their life go IPO, they're dilutive, and they see a lot of very short-term spin. The cycle is getting shorter and shorter. How should they view stocks, and what's your message for them? Finally, Cora and I would love to thank you in person and shake your hand personally today. I'll repeat what I said last year. Thank you for setting the seeds for my generation to sit under shade, and for my children's generation to sit under shade with the Secret Millionaires Club. I truly walk amongst giants. Thank you.
Would you mind repeating the whole thing? The Secret Millionaires Club, we want to give great credit to Andy Hayward on that. I think it has helped. I know it's helped thousands and thousands of children, and it was Andy's idea, and it grows in strength, and having young children learn good lessons in terms of handling money and making friendships and just generally behaving as better citizens it's a great objective, and Andy makes it easy for him to do. So on his behalf, I accept your comments. You don't have to really worry about, what's going on in IPOs or people making money. People win lotteries every day, but there's no reason to have that affect you at all. You shouldn't be jealous about it. I mean, it's great, if they want to do mathematically unsound things and one of them occasionally gets lucky and they put the one person on television and the million that contributed to the winnings with the big slice taken out for the state, don't get on there. It's nothing to worry about. Just all you have to do is figure out what makes sense, and you look at buying. When you buy a stock, you get yourself in the mental frame of mind that you're buying a business. And if you don't look at a quote on it for 5 years, that's fine. You don't get a quote on your farm every day or every week or every month. You don't get it on your apartment house if you own one. If you own a McDonald's franchise, you don't get a quote every day. You want to look at your stocks as businesses and think about their performance as businesses. Think about what you pay for them as you would think about buying a business, and let the rest of the world go its own way. You don't want to get into a stupid game just because it's available. And I'm going to say a little bit more about that close to the break. But with that, I'll turn it over to Charlie.
Yeah, well, I think that your children are right to look for people they can trust in dealing with stocks and bonds. Unfortunately, more than half the time, they will fail in a conventional answer. So they really have a hard problem. If you just listen to your elders, they'll lie to you and spread a lot of folly.
But they really have an easy problem.
What?
In the sense that American business as a whole is going to do fine over time. So the only way that they can...
But not the average client of a stockbroker.
Well, we'll get to that later. The stockbroker will do fine.
Yes, that's true.
Yeah, but they don't have to do that, and we can talk. Well, I'd rather address that just a little later. But you don't want to worry. You don't want to be. A lot of problems, Charlie would say, are caused by envy. You don't want to get envious of somebody who's won the lottery or bought an IPO that went up. You have to figure out what makes sense and follow your own course.
Thank you, Warren. This from a shareholder asked to remain anonymous. If Donald Trump becomes the President of the United States, and recognizing your public criticism of him and your public support for Hillary Clinton, what specific risks, regulatory, policy, or otherwise, do you foresee for Berkshire Hathaway's portfolio of businesses?
That won't be the main problem. Well, government, is a very big factor in our business and in all businesses. I mean, there's the very broad policies that affect practically everybody, and sometimes there can be some pretty specific policies. But I will predict that if either Donald Trump or Hillary Clinton becomes president, and one of them is likely to be, very likely to be, I think Berkshire will continue to do fine. Charlie?
I'm afraid to get into this area.
Yeah, we've operated under we've operated under price controls. I mean, we've had 52% federal taxes applied to our earnings for many years. They were higher at other times, but we've had regulations come along, and in the end, business in this country has done extraordinarily well for a couple of 100 years, and it is adapted to the society, and the society is adapted to business. This is a remarkably attractive place in which to conduct a business. Imagine in a world of practically zero interest rates, American business earning terrific returns on tangible equity. I mean, those are the assets that were actually employed in the business. The numbers are staggering. And, people who've had their money in savings accounts or something like get destroyed. But owners of business, if if you look at returns on tangible equity, just check them out sometime, and they have not suffered, even as people who own fixed income instruments have suffered enormously. And farm prices are down now. Farmer income has fallen off a lot in the last couple of years, but businesses managed to take care of itself, and for a good reason, because it contributes to and has been the engine of a market economy that's delivered output that is staggering by the imagination of anyone that might have existed 100 years ago. In my lifetime, the GDP per capita in real terms of the United States has gone up 6 for 1. Can you imagine in a society where in one person's lifetime, overall, people have 6 times the real output that they had at the beginning? It's the system works very well in terms of aggregate output.
What do you think about the stock market overall? The Dow just hitting 4-year highs this week.
Well, of course, averaged out, we're pretty agnostic about the market at Berkshire. We try and swim better than the tide and take the vicissitudes of the tide as they come. But I do not think that the civilization is going totally to hell or anything like that.
Retail investors have not come back into the market in great form since the 2008 downturn. They haven't been back as quickly as institutional investors and hardcore traders. Do you think that they are
Well,
doing
the whole
themselves...
market is more institutional than it used to be.
But are
So,
retail investors doing themselves a disservice by not being involved?
Well, I think the ordinary investor who actively is trading with the help of the ordinary stockbroker is going to get a result which is way worse than the market provides.
You mean just indexes, investing
I
in
just
index
think
funds?
the people who listen to CNN and want to be do-it-yourself investors, averaged out, they're going to be losers.
So what should they do? Just follow the indexes?
Well, if you don't know very much, you should buy an index. And knowing enough to make alternative conduct safe is something that's always going to be a minority sport.
What about the idea of staying out of stocks and looking for alternative investments because they got burned by the market overall?
Well, that's a natural thing to do. But what we've always tried to do is to be just the opposite. In other words, when everybody is totally discouraged and think the world is going to hell, that's when we like to be buying.
Does this still look like one of those opportunities, a buying opportunity?
Well, it doesn't look as much so as it did at the bottom tick.
He was the single most successful investor of the 20th century. Time magazine named him one of the most influential people in the world. He's worth over $70 billion. He's Warren Buffett, and here are his top 10 rules for success.
How can other people tap dance to work? What's the secret of that?
You find your passion. You find your passion. I was very, very lucky to find it, when I was 7 or 8 years old, and fortunately, my children have found their passion. One son loves farming like nothing else. One son loves music like everything else, and all 3 of them love philanthropy and what they get to do. You're lucky in life when you find it, and you can't guarantee you're going to find it in your first job out. But I always tell the college students that come out, I say, take the job that you would take if you were independently wealthy. You're going to do well at it. If you think you're going to be a lot happier if you've got 2x instead of x, you're probably making a mistake. I mean, you ought to find something you like that works with that, and you'll get in trouble if you think that making 10x or 20x is the answer to everything in life, because then you will do things like borrow money when you shouldn't, or maybe cut corners on things that your employer wants you to cut corners on. Or it just doesn't make any sense. You won't like it when you look back on it. 3 things in hiring people: look for integrity, intelligence, and energy. And he said if the person didn't have the first 2, that the latter 2 would kill them, because if they don't have integrity, you want them dumb and lazy. You don't want them smart and energetic. It never bothered me if people disagreed with what I thought, as long as I felt I knew the facts. I mean, there's a whole bunch of things I don't know a thing about. I just stay away from those. So I stay within what I call my circle of competence. You know, and Tom Watson said it best. He said, he said, I'm no genius, but I'm smart in spots, and I stay around those spots. Well, I try and stay around those spots, and I just don't have a problem if somebody says, you're wrong on something. I go back and look at the facts, and I think that really is much more important, frankly, than having a few points of IQ or having an extra course or two in school or anything of the sort. You need emotional stability. I just read and read and read. I probably read 5 to 6 hours a day. I don't read as fast now as when I was younger, but I read 5 daily newspapers. I read a fair number of magazines. I read 10Ks. I read annual reports, and I read a lot of other things too. So I've always enjoyed reading. I love reading biographies. Famous lesson about a margin of safety, that you don't drive a truck that weighs 9,900 pounds across a bridge that says limit 10,000 pounds, because you can't be that sure about it. If you see something like that, you go down a little further down the road and you find one that says limit 20,000 pounds, and that's the one you drive across. The nature of capitalism is that people want to come in and take your castle. It's perfectly understandable. I mean, if I'm selling television sets or something, there's going to be 10 other people that are going to try and sell a better television set. If I have a restaurant here in Omaha, people are going to try and copy my menu and give more parking and take my chef and so on. So capitalism's all about somebody coming and trying to take the castle. Now, what you need is a castle that has some durable competitive advantage, some castle that has a moat around it. And that moat, one of the best moats in many respects, is to be a low-cost producer. But sometimes the moat is just having more talent. I mean, if you're the heavyweight champion of the world and you keep knocking out people, you've got a competitive advantage as long as you can keep doing it. And it's very profitable if you're the one that happens to be able to do it. If you can turn out great motion pictures, I mean, Steven Spielberg, I mean, he's a fellow to bet on, and it has enormous economic value. You'd be surprised at my days. I mean, they're very unstructured, no meetings, none. I mean, I don't like meetings, and I read a lot. I wish I were a faster reader. I'd get more done, but I do read a lot, and I'm on the phone a moderate amount. Our businesses run themselves basically out there. My job is allocating capital, and that's what I'm thinking about. But I don't like to have things all packed hour to hour to hour. And Bill and I are both extraordinarily lucky. I mean, we really get to do what we like to do, the way we want to do it, with people that we choose to be around, and they're terrific. I mean, we've really got everything our way, and we're very fortunate. And in his world, he has a different kind of pace than I have, but we both love it the way we do it. And my guess is that we're each the most productive in that particular mode too, because it fits our personalities and aptitudes. What kills great businesses, if you look at, I do believe in looking at history, and I like to study failure, actually. And my partner says all I want to know is where I'll die, so I'll never go there. And we want to see what has caused businesses to go bad. And the biggest thing that kills them is complacency. I mean, you want a restlessness, a feeling that somebody's always after you, but you're going to stay ahead of them. You always want to be on the move. And when you've got a great business, like Coca-Cola, which is, there aren't any like Coca-Cola, but you really, the danger would always be that you rest on your laurels. But I see none of that, obviously, at Coca-Cola. But that is the key, to compete the same way when you've got 1.8 billion servings being sold daily as when you were selling 10 a day. And that restlessness, that belief that tomorrow's more exciting than today, you just have to have it permeate the organization.
Who was Ben Graham? He was your primary mentor, model?
He was a wonderful man, and he was my professor at Columbia. I read his book when I was 19 at the University of Nebraska, and I'd started investing when I was 11, and I started reading about it when I was like 7. So I'd gone through I read every book in the Omaha Public Library that there was by the time I was 12 on investing and stock market. And I had a lot of fun, but I never really found out, I never got grounded in anything. And it was entertaining, but it wasn't going to be profitable. And then I read Graham's book, The Intelligent Investor, when I was at the University of Nebraska. And
pulled it
that
all
just
together.
opened the whole thing up to me. Yeah, and I named my oldest son is named Howard after my dad, Graham Buffett, and he was a marvelous man. Never expected anything from me in return. Ben Graham, in his low teens, looked around and he looked at the people he admired, and he said, I want to be admired, so why don't I just behave like them? And he found there was nothing impossible about behaving like them. And similarly, he did the same thing on the reverse side in terms of getting rid of those qualities.
You have given a lot of fabulous advice, but what's the best advice that you've ever received?
Well, I received it in a variety of forms, particularly from my father when I was very young. But I mean, he basically, I think, taught me how to live. Not that I did it perfectly or anything like that, but I mean, he was giving me lessons, but he wasn't doing it by preaching to me. He was doing it by example. But basically, well, the biggest lesson, in a sense, I got is the power of unconditional love. I mean, I think there is no power on earth like unconditional love. And I think that if you offer that to your child, I mean, you're 90% of the way home. And there may be days when you don't feel like it. It's not uncritical love. That's a different animal. But to know you always can come back, I mean, that is huge in life. That takes you a long, long way. And I would say that every parent out there that can extend that to their child at a very young age, it's going to make for a better human being.
And you felt like you got that kind of unconditional love from your dad.
I absolutely did, yeah.
That is a powerful thing.
It is a powerful
Morning
thing.
Star, I'm Jeremy Glazer. I'm here with Greg Warren. He's our Berkshire analyst and just finished asking questions of Warren Buffett and Charlie Munger at the annual meeting. Greg, thanks for joining me.
Thanks for having me.
So let's talk a little bit about just kind of the tenor of the meeting. It seemed a little bit more substantive this year than it has been in the past.
Yeah, it was pretty good from that perspective. I mean, I think the fact that Warren brought in the 3 journalists and the 3 analysts a few years ago, the whole intent was to try and get some more substance into the meetings, opportunity for them to talk a lot more about the businesses. Surprisingly, I'd say across the breadth of questions, it was pretty good, pretty well focused. Not a whole lot of sort of focus on hot topic issues right now, like the political environment or anything else like that. So I think from that perspective, there's a lot to walk away with.
So let's look at what we learned. Let's start with railroads. BNSF and other railroads have been under pressure. What kind of insights did you gain on that business?
Well, on the railroad business, we actually asked one question that was related more to consolidation. Canadian Pacific took a swing at Norfolk Southern late last year, created a lot of consternation within the industry, from lawmakers and whatnot. Basically, they had to walk away from the deal. And my question was, what's it going to take for consolidation to take place? Warren, deferred to Matt Rose on that one. And he sort of let us know what they're looking for as far as environments and conditions for consolidation to take place. And in their view, it's going to take a much greater increase in the population level in the United States for the regulators to potentially okay any sort of deal, and they'll definitely be first in line when it looks to sort of do a combination with another railroad. The other thing that came up was just the idea of capital spending, and sort of revenue growth and profitability, given what's been taking place in the commodity markets. Crude oil shipments are down significantly. Coal shipments are down drastically, over the last year, and how the industry is sort of dealing with that. I mean, BNSF is not alone, because everybody else is feeling the same pain. But when they look at sort of where CapEx is going to be spent going forward, it's likely not going to be on those areas. They've already spent significantly on crude oil. Coal really doesn't need a whole lot of incremental investment. So we look to more intermodal sort of projects, anything else to sort of enhance the service capabilities, the networking abilities. And Buffett did make a huge point there that CapEx spending, is going to have to be meaningfully above depreciation on a go-forward basis, because they can't just maintain the rails and hold serve. They're going to have to actually spend more in order to sort of develop opportunities to offset some of what they'll be losing over the long run.
Speaking of another area where they will be investing heavily, Berkshire Hathaway Energy. What did we learn about that business, particularly on the renewable side?
Well, we knew coming in that they had invested another $3.6 billion in another wind farm in Iowa. This is going to take their capacity generation in that market up to 85% from renewables or from wind power exclusively. That's phenomenal. You just don't see that anywhere else in the market. And Iowa so far has been very, very conducive to them doing this. The lawmakers have been working with them. It's good for the consumers. The cost of electricity is actually cheaper in Council Bluffs on the other side of the river here than it is in Omaha. The one thing that Warren did bring up during the course of the meeting was the fact that you've had a lot of data farms cropping up in Iowa. Like Google has a big farm out there, and a lot of the other firms are starting to set up big data centers because it's much cheaper for them to operate it there. It creates jobs for those local environments. So, from that perspective, Mid-American, which is a subsidiary of Berkshire Hathaway that's there, is doing, definitely the right thing for not just society there, but also for their longer-term cost perspective.
Switching gears a little bit, talking about share buybacks. You asked Warren a question about this, about when they would buy back shares. Did you learn about when they're going to actually go in there and purchase them?
Yeah. When we look at share buybacks, I mean, they've had a threshold out there for a while at 1.2 times book value, and we've not really seen a meaningful amount of share buybacks over the last 4.5 years. Part of that's because the stock's just not gotten there. I erred a little bit in my calculation on where book value per share, where the threshold was, in the first quarter of this year. There were a couple days in January, February where, the stock actually got very, very close to tripping that threshold. But I ended up getting sort of the right answer out of the question, which was, is he willing to step out there and buy back stock during the quarter, even though he may not have released what the end of quarter book value per share is? And he basically affirmed my sort of belief that he would do that.
Any other big takeaways from the meeting?
Overall, like I said, there's a lot of good different things that came through in different ways. I'm going to have to dig through and sort of rework through my notes and information and come to some different conclusions. But again, as we started out with the conversation here, I felt this meeting was a lot more fruitful than we've seen in a while.
Well, Greg, thank you. I know it's been a long day, so thanks for joining me.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.